Assalamualaikum warahmatullahi wabarakatuh. We're from Group 5, going to present on the Spain financial crisis. Our team members including Muhammad AMIRUL ANUAR, Muhammad DANIAL NAWAWI, SOFIEA YAHAYA, and me, ADAWIYATUL MUNIRAH. So I'm going to start the presentation by explaining the background of Banco de Espana. Okay. Banco de España was originally named as Banco Nacional de San Carlos and was established in 1782 in Madrid by Charles III. Initially, the bank was not nationalized and was owned by several stockholders, including some Spanish capitalists, French rentiers, and several treasuries, surprisingly including Indian communities in colonial Mexico. Next, the nationalization of Banco de España. The bank was only then nationalized in 1962, following the reinstatement of democracy in the late 1970s. This allowed the bank to have more transformation along the years until 1994. Next, the governing structure of Banco de España. The governing structure are separated into 4 branches, which includes a governor, a deputy governor, governing council, and executive commission, with the highest rank owned by the governor. And next, Banco de España functions as an institution which defines and implements the Euro system monetary policy, which allows them to own about 8% of the whole Euro nation system currency. Next, I am going to pass this on to Sophia Yahya.
Okay, thank you. So I'll be explaining on the financial problem. So in Spain, apparently there are a few years that occurred, but especially it started in 2008 till 2012. So as we can see that in 2009, it was the hardest year where the GDP fell at 6.3% and the employment increased by 800,000 people. In 2010, it began a recovery with the output growth of 0.6% with accumulated loss of production from the previous year, which was 5%. Following in 2011 shows the weakness of the recovery. But it managed to establish a new version of the stability program for the year 2011 to 2014. This program has an objective, and which is for the public deficit to reduce to 3% of the GDP by the end of 2013. The public debt ratio will stabilize just below 70% of the GDP in the 2012 to 2013, with the 65% of the adjustment in the 2009 till 2013 based in spending cuts, including a deep reduction of the public consumption. So finally, in the 2012, as the Spanish cabinet was new established in the 2008, they managed to request a financial assistance package from European Financial Stability Facility. Next. So in this financial problem, there was a few issues that was related, and that was the employment rate, Eurozone, private debt, and public investment. As you can see, for the employment rate between 2007 and 2010, the employment rate in Spain rose from 8.3% to 20.1%, which was 463 to 000 unemployment in 2010. For the Eurozone, when the domestic demand fell from 7.6%, Eurozone fell merely 1.6%. The ratio of the debt is at 125% higher than the average Eurozone. Following up with the private debt, the investment in housing was most affected, which was in 3 years decreased by 41%. And finally, the public investment, which is the Spanish public debt in 2010 was 60.1% of the GDP. Next. So in this financial crisis, there happens to occur an issue of this financial risk under the interest rate risk and market risk. So in the interest rate risk, the interest demand by the market from the Spanish government to lend the money for 10 years has raised above 6%. Following up with the market risk, current market fears of the economic policies being signed out by the Eurozone, which actually set back the economy of Spain. That's all for me, thank you.
Okay, so I'm going to continue with the main cause of the problem. So there are three main causes, which are the property bubble, the unemployment problems, and the price competitiveness. So for the property bubble, between 1996 to 2007, the prices of Spanish property tripled and popped during the crisis. A massive growth in all three demands, prices, and supply projects a huge bubble. This huge credit allowed for construction and property development activities was a big mistake, as it exposes the banking industry to this sector, which means the housing crisis Okay, next for unemployment problems. As construction industry fall and collapse, more people are losing their job and homeowners are over indebted to the bank, causing a big bad mortgage debt. This means that the number of people who are paying income taxes are decreasing at the same rate as the economic downfall. And the unemployment rate of Spain has reached more than 20% of the workforce, which causes the government to face a difficult fiscal situation, and the interest rate gap for treasury bonds with Germany is widening. And lastly, the price competitiveness. The lack of competition divides the interests of Spanish entrepreneurs, with most of them preferring to develop more non-tradable goods. However, Spain belongs to the Eurozone, so their economy is in the competition with other European countries with a fixed exchange rate regime. And by this time, Spanish is already facing more inflation with a decrease in productivity gains compared to other Eurozone countries. Next, I'm going to pass this on to Amirul.
Okay, now I will talk about how Bank of Spain react on the financial crisis. Regardless on the influence of the recession on the financial system and its impact on the real economy, there has been a universal consensus in Spain for many years on the needs for a comprehensive restructuring of the banking sector in general and of the saving banking sector in particular. Okay, first of all, thank you to the country traditional banking rule and practice. The Spanish banking system has been credited as one of the most resilient and well-prepared of the Western economic to deal with the financial global crisis. Banks are anticipated to have a high capital provision and to claim different facts and share from the expected creditor. Nevertheless, this trend will greatly relax after the mortgage crisis, a phenomenon to which the regulator Banco de Espana turned a blind eye. By recovering deficit and revenue fluctuation, Spain's unconventional accounting rules designed to smooth earning over the market cycle have deceived a regulator and analyzed the dynamic provisioning accounting strategy which ignore the requirement established by the International Accounting and Standard Commission, blur the capital cushion until they are exhausted, causing well-being to emerge issue and haunted. Next. And how Bank of Spain react for this case is the regulator and supervisory mechanism were set in a place by the Spanish authorities. This situation could have initially protect the Spanish financial system for the immediate impact of the global financial crisis. In fact, in the Banco de Espana introduced as a regulator structure demanding for a greater provisioning which enables Spanish bank to withstand the losses suffered by the onset on the financial crisis in the first place. The Central Bank of Spain appeared as a verge on the bankruptcy on the summer on 2012, and the recession on the sector prompted into the European to formulate an emergency bailout on the by 100 billion for the Spanish banking sector. And in November 2012, the European Commission approved the proposal for the reduction and consolidation of three main banking sector in the Spain. The first Spanish banking has been bailed out by the bank. And finally, it is also possible to blame on the financial crisis on the action or inaction of the Bank of Spain, one of the key players involved in the bank negotiation, the policies of the bank, and we are all celebrate on the set of the crisis and we are taken as a model by the nation. However, time and appreciation and during the recession, the Bank of Spain was blamed and action the decision or lack thereof. The road of the least resistant and selected by the Spanish Central Bank, advising about the threat of failing to act decisively. Next, I will pass to Muhammad Daniel Nawawi.
Okay, the strategy against the problem. For several years, in Spain, there was a broad consensus on the need for thorough reform of the banking sector. The reform process did not materialize until 2010, two years later than in the most European country and the US. The beginning of the crisis showed that it was necessary to move quickly with the deep reform process, mainly a structural reason. In 2009, a new institution with a key role in the process of bank restructuring was created, in so-called Fund for Orderly Bank Restructuring (FROB), whose principal aim is strengthen to solvency of bank by providing funding to facilitate the process of restructuring. The FROB was created in order to find solution for entity with specific difficulty, thus minimizing the use of public resource. In 2010, the number of steps were introduced in order to maximize financial transparency, so as to boost the investor in the Spanish banking. The FROB was the next year, due to the increased tension in the debt market, the Bank of Spain boosted the minimum core capital requirement to 8% to 10% of the weighted reserve, depending on the particular characteristic of the bank. This measure further helped the FROB to act as a burden recapitalization instrument for those banks who are unable on their own to meet their minimum threshold. Next, strategy. A key aspect of the bank restructuring model developed in Spain is its orderliness, which contrasts with the bailout, capital injection, and other piecemeal measures previously implemented in other European banking systems. The reform of the banking system that integrate the measure described above the three main objectives, which is reorganization, recognition of losses, and capitalization. On 2012, the provision of up to 100 billion of rescue loan from Eurozone fund. The main focus of this initiative was the subsector of the saving bank, as they acknowledged asset loss of close to 52 million euro in that period. Finally, they raised their money. They raised their money mainly by deposit by amount of equal 3.7% of GDP under the aim of recapitalization banking institution. The recapitalization involved an effort to improve the Tier 1 ratio, which rose to 7.6% in the late 2007 to 9.5% in the late 2010. For recommendation, I will pass back to Amirul.
Okay, I will brief about the first and the second recommendation, which is identify the problem and short-term policies. Okay. First, we also need to identify problem. What is the primary problem that is causing the difficulties for Spain in the reason of the housing bubble and the accompanying unsustainability and high GDP growth rate that causes the financial problem to the countries. And the Spain financial institution need to react quickly to set up the plan to recover from the problem and need to recover before it getting worse to help the government also. And the second one is the short policy recommendation. Financial institution should rearrange the financial sector stabilization. This is because the Bank of Spain should increase the monitoring and developing contingency framework from the systematic financial crisis. As a central bank of Spain, they should allow banks to start raising capital immediately to reinforce capital level for levels far above prudential requirement. This movement will go give the market strong sign and banks are approaching the crisis from the position of strength rather than the vulnerability. This situation is under the strength bank capitalization. Next, I will pass to Muhammad Danial.
For fiscal policy, it is therefore important to preserve confidence in the long-term soundness of public for economic development and prosperity. This indicates the need to focus on a more than usual position for monetary policy and taxation in order to sustain aggregate demand. And the last one, learn from history. Spain should learn from other country mistake before it happen to them and prevent it in future. For example, many other country has already in financial crisis before Spain. So Spain should learn from them and prevent it before it happen. And from this event in financial crisis that already happened, Spain should learn it before it happen again in the future. I think that's all from us. Thank you.